My name's Neil Beeman. I'm a partner at MUN CPAs, member of CMTA, deal a lot with manufacturing, a lot on the R&D space, mostly small, medium-sized businesses and the owners of those businesses, we do their returns. And so what we wanted to do is, I've been talking with a lot of clients lately about obviously the new big, beautiful bill, whatever we want to call it, that passed in July. And I've had a lot of people ask questions. There's a lot of things that have been changed that are good for our industry. There are a lot of things that didn't change anything, but made some more things permanent. So what we're trying to do is, or what I wanted to do is just kind of go over some of the items that I've been getting asked about. So I know there's some interest in there out in the community. And if you have questions or if anything, please feel free at the end of the presentation. There's some contact information. I'm happy to talk to anybody. It's whatever we can do to help manufacturers here in California. That's kind of how we operate. So I'm happy to talk anytime. But I'll go ahead and get started. If there's anyone who's got questions, please feel free to just let me know. What ended up happening is July 4th was a Friday. We had this fairly decent sized tax bill that passed. It was signed into law. With a lot of things that gave us some clarification on items that we just didn't know, which was helpful because it happened in 2025 and a lot of it affects 2024, which is usually the way things go. But it does give us some ideas for how we can plan for this year, some items that we could do for the prior years, and some things to think about for the future upcoming years. And so I've tried to put together some items that we're getting asked about that don't have necessarily a whole heck of a lot to do with the manufacturing community, but people keep asking me about it. So I just want to go over it quick. But I've kind of broken down a few different areas here. Some of how the impact's going to be for your employees, impact some on your business, and then some on your personal side. And for those of us that are the small to medium-sized business owners, a lot of times closely held company, S corporations, LLCs, anything that happens on the business side will kind of directly affect what happens on your personal side. So I'll kind of get through all of that, but I wanted to start here with the impact on your employees. People are getting a lot of questions from their employees on certain items. So I just wanted to, been trying to help my clients, been trying to help them answer some of these questions. The first one is the tips deduction. I've actually gotten this a lot from manufacturing community. The way the tips deduction works is that you need to be in the kind of business that typically gets tips. And I'm not real familiar with too many manufacturing sides of things where there's a line when you send out an invoice that says, please put tip here. The reason people are asking me about it is there something that we can do to maximize the way that we're paying our employees so that maybe some of it's through tips? It doesn't seem like there is right now. Maybe something changes down the road, but for what we've, as the tax community's been told right now, and what we can see in the rules, there's really nothing that you're going to be able to do on the manufacturing side. Maybe you got an employee's got a spouse, or if you have a spouse that's in the type of business where they usually get tips and your income's under 300 grand if you're married, then maybe there's something to be there for the tip credit. And I just don't see it really affecting us too much. So I don't want to spend a lot of time on it, but I do have people asking me about it. So I wanted to put it in there. It's something I didn't know I was going to ever really think about was tips when it came to manufacturing, but what the heck, let's go for it. The other item that does come up a lot is the overtime deduction. And so I have clients, obviously most of our clients are the business owners. And what we're trying to figure out right now is that every once in a while, government throws something out there that is a way to basically, if you could put $1 into the system and save $1.05, then why wouldn't you do that? And so we're trying to figure out whether or not there's a way to use this overtime deduction to, one, help our employees. To, if there's someone who's generally getting overtime and their income's going to be in that 300,000 if they're married, or 150, then this could save, they could not have to pay 12,500, or not have to pay, but they wouldn't have to report 12,500 up to 12,500 per person for overtime pay. For your employees, that could have something to do. If you have someone who you're paying $100,000 a year to, and they have 10 grand overtime, well, that would be something that they could not necessarily have to include in income, depending on what they have going on their personal side of things, which is super helpful. I know that that's going to affect some of our clients, and for us as the employers, as the owners, there's not like a really set way yet that we're supposed to be reporting it, but it's all going to happen on their personal tax returns. It's not, we're going to probably have on the W-2s or on a pay stub, but somewhere on the W-2 box 14 or something, it's going to say, overtime paid this year, $10,000 or $5,000 or whatever the number is. So that by itself is going to be fairly straightforward. Our payroll company is going to handle that. If you prepare payroll inside, you're going to have to do something, but there's not really, we don't have real direction on how that needs to be reported right now, but you're going to make it fairly easy for the employees to find it. As far as then, if we can find a way, if we have employees is like, well, I really care about my employees and I would love for, if I'm paying somebody $100,000 a year, is there a way for me to move part of that 100 grand into overtime so that they could take advantage of it without me having to pay them more than 100 grand for the year? That gets a little confusing. I can understand the idea to do it. The problem that I see is that, let's say you have, for a 2-week period, you pay them overtime to what equates to $12,000. And then for the next 4 weeks after that, you have them on part-time so that they are getting paid less those other 4 weeks, and you've, supersized that first 2 weeks. But yet you still want them to work the same in those past 4 weeks. You have a whole lot of liability as an employer where you're not paying them for their time. So I don't see there being a really easy way to try to kind of game the system, I'd say, and bank some of that into one pay period and then have a smaller part-time type of pay period after. I don't think that's going to work very well for us, just especially here in California. But if you do have employees who have overtime, then I think it will work out for them. If you have family members that are employed, it's possible that your family members can do it. Now, this is for hourly employees. So what you end up having is you have exempt employees that are salaried. You as the owner are typically exempt employees, so you won't be able to qualify for this. And your incomes are going to usually, I would think, be over the $150,000 or $300,000. But so for the owners, we don't really have a good way to do it. Possibly for children, we could, if you got your kids on payroll, or if you've got, family members or some other people that might be on payroll, it's possible that they have some ability to do that. But if you're going to have them on, they're only going to get paid for 6 weeks, maybe you have, or 10 or 20 weeks or whatever it might be, maybe you do have some of it be overtime and be able to put some of that into that qualified overtime area. Just got to remember, especially for younger kids, that if they're under like $16,000 in total wages, they don't even have to really file a tax return right now, at least on the Fed, maybe a little on the state. But it's one of those you can take a look at. It wasn't as interesting as it maybe sounded when they first came up with it. We're going to have all of our clients pay themselves nothing but overtime, but that's not really a good workaround for that. Right now, maybe that changes. One of the things that we do have, or not just one, but on many of the things in this new bill, is that we're still waiting for direction on a lot of the items. Just, here's what the rule is, but how is that going to practically work? We're not really sure. But this is one where we all kind of like, oh man, maybe if there's a way for us to use that, that, we want to try to take, make sure this is beneficial as possible to our clients. And right now it's going to just be for those who do qualify for overtime, they will get some rate. I always am a little hesitant on trying to say you should tell your employees how to file their taxes or anything, but you are going to have people, it's like you should take and look at the overtime part. They have it. They may not know. And it's very possible they won't know about it. And it's certainly, if they can save some taxes on it and you let them know, they're not going to be upset about it. It's like, hey, on their W-2s, this is where it's going to show. So educating your employees it's could be helpful for them. Obviously you don't want to provide tax advice, but it's something that I just don't know. I read this, business owners know about it. I don't know how many employees are really going to be paying a lot of attention to it. The tips and overtime reported maximized deductions. Yeah. And it doesn't reduce your claims again on the tip stuff. So the family leave, those types of items, it won't have any effect on those. I just don't think it's going to matter on the tip side for most of us business owners. The impact on your business. Now, these are items that will have more of a direct impact. Getting a lot of questions on the tips thing, got a lot of questions on the Social Security. Not Social Security, but the overtime. What we have really seen is going to have the impact of these following things. And one of the first ones is going to be the bonus depreciation. Excuse me. So what had happened is you've got a couple of different kinds of depreciation. Is like you go out and you buy a piece of equipment or a piece of real estate, and the government has a lifetime you have to write that off over. So like a vehicle's 5 years, piece of equipment 7 years. So you take that and you write it off over 7 years. they give us some ways to accelerate those depreciations, to take more deductions currently. And one of those is the bonus depreciation. We had the bonus depreciation have been going down steadily. You know, it was 100%, 5 years ago, and went down to 80%, 60%, 40%. It was getting ready to go away. They have now come back and they've given us 100% bonus depreciation up through 2030. Bonus depreciation is good because it allows your business to drive a loss if it needs to. It also gives us the ability to write off some items that we can't necessarily write off with the other fast depreciation, accelerated depreciation, which is called Section 179. And I'll talk about that in a second. But the bonus came back. It's really good. It's helpful for if you're going through and you're buying. Some people buy real estate and you're going through and doing what they call cost segregation studies, or you're going through and you're buying a piece of equipment and maybe you have other businesses or other items to where driving a loss in one of these entities is going to help you offset other income. The second bullet point there, I put that in just because that's actual words from the IRS tax code, and it's one of the more confusing sentences that you can read. Any improvement made by the taxpayer to an interior portion of an existing building that is non-residential real property, as long as that improvement is placed in service after the building was first placed in service by any taxpayer. What that says is that if you go out and you buy a piece of real estate that you can take in commercial, non-residential buildings, the life that the government has given them is 39 years. And so if you go buy a piece of real estate for $1 million, just going to use a small round number, for $1 million, first you're supposed to take and allocate some of that to land, and that could be like 30%. And then that remaining amount, 700,000, you're supposed to take and write that off over the next 39 years. Which means if you went and spent 200 grand down on $1 million building, you'd only be able to write off 1/39th of 700 grand, which is like, $18,000. So there's not a lot of tax benefit. You're going to be cash poor, but you're not going to have a lot of tax benefit to help offset that. What bonus depreciation does, and what this second benefit or the second bullet point is trying to say, is that the building itself maybe is only 39 years, but you can go inside and do what's called cost segregation studies and say, look, there's flooring, there's window covering, and there's certain kinds of, my building, these walls are fairly temporary, and some of the electrical and some of the plumbing, there's items that you can go through and allocate different depreciable lives to, and write them off much faster. And bonus depreciation allows you to take and write them all off immediately and develop a loss or create a loss in whatever entity. A lot of times you're holding real estate in an LLC that you can then use to maybe offset some other income that you have coming in on your returns. Bonus just gives us some more flexibility with how we're going to be able to deduct some items. And in the past, it was getting limited to 40%, and now we've got it at 100. So that's a bonus. That's a plus for our businesses. The Section 179 I was talking about, it also lets you write off items quickly. So if you go out and buy a piece of equipment for $1 million, you could write off $1 million. But if your business is not profitable, you can't drive a loss in this. So 179 can't drive a loss. State of California only lets you write off 25 grand no matter what. So it's a little different, but it's still available. And they moved it up now to 2.5 million. Still very helpful. Not quite the same on certain building items for those non-residential buildings. So the bonus has its place. 179 has its place. Kind of the opportunities you got here, bonus, like I was saying, it allows you to drive to a loss, which can help. It's oftentimes on our tax returns, we don't just have one thing of item. We've got W-2 income. We've got some other stuff that's possible with an S corporation. We could generate loss and offset some larger W-2 income. So there's some benefit to the bonus. Section 179. I like 179 for its ability to kind of get around this net operating loss items. So what happens is if your business generates a loss, you can only use, if the next year you carry this loss forward and you have $1 million profit, you can only use $800,000 loss. It's limited to 80%. 179 doesn't have that same restriction. So it's possible, depending on how you do your tax planning, to take and do a bunch of Section 179 this year. It won't create a loss, but the unused portion will carry forward to the next year, to which it doesn't have these same limitations. So there's some ability to plan for which one of the, you get to choose on almost any of these. What do you want to use? And so you kind of pick and choose which way do you want to do the bonus? Do you want to do 179? Does it make sense to take just a little bit of 179, take it all. There's all sorts of things you can do for planning, but at least now we have the ability to put bonus back in on the list of tools that we have. Other parts that we've got that's good is the Section 199A deduction has been made permanent for these pass-through. So pass-through entities are like S corps, LLCs, maybe some LLPs. It's really made more for the manufacturing side. The service industries like myself, like a CPA firm, law firms, we don't have as good of a benefit on these. We're kind of restricted. But the idea between the Section 199, as you can see there, the C corporation tax rate's at 21%. The top individual tax rate right now is 37%. So to kind of equalize those two items out, the government put in this 199A deal, which says that on your tax return, you take whatever your profit is, multiply it by 20%, some restrictions, but this is just the basic math. And you get that 20% deduction on your return. So if you had $100,000 of profit and you take this 20%, you'd have a $20,000 deduction. It looks like you went and bought a $20,000 piece of equipment without you actually having to spend the money. Most likely if you've qualified for this, you've all been taking advantage of it, even if you don't know it. Most of the softwares do it kind of automatically. There are some planning items to making sure that you maximize your wages and do things properly. But that's one of those that's kind of just, it's been around and we just do it for our clients. You know, if there's some benefit to be made by backing off on some deduction or doing something with wages, we tell them about it, but chances are you've been taking advantage of it. Good news, made permanent. It's very helpful. I'm glad to see that one done. There was some talk about maybe changing that up a little bit. And it's still there. The PEAT, the pass-through entity elective tax, elections are still allowed here in California. This is one that you've probably also been doing, where the corporation pays your state income tax, basically, and then you get a credit on your personal tax return. They left that workaround intact. There's now going to be a little bit of some planning opportunities because of that SALT, that state and local tax increase from 10,000 to 40,000, and I'll talk about that here in a bit. But the PEAT's still around. The idea on this one is that on the California side, the taxable income to California, you take that, whatever that number is, and you multiply it by 9.3%. You can't do more, you can't do less. You have to do 9.3. You pay in that tax, you pay in that money through the corporation, you get a credit. So let's say you had 100,000 of profit, $9,300 is what you pay in. You get a credit that flows through to your personal tax return, so you get to offset your personal California income taxes by $9,300. But then the company on the federal side gets to write off that $9,300 just like it's any other business expense. So that's how we were getting around the limitation on SALT. And so pretty much all of my business clients that were pass-through types of entities were taking advantage of this. I don't really know why you wouldn't. Well, I do know why you wouldn't, but it's a limited amount if you're a closely held business. So if you have other partners, you're at a loss. You know, maybe there's something to be said for not. There's something to be said for not going through and doing that. Maybe the cash flow in the business isn't really good. So you just, there could be some reasons for it, but most of my clients who were profitable, we took advantage of this because you're going to have to pay the tax on your personal anyway. Why not get some sort of federal deduction that helps offset some of your tax? It's just, you're going to have to pay it anyway. So why weren't you taking advantage of it? Anyway, they left that in, which is good. That's a good thing. This opportunity here to maximize the 199 and the pass through. What you see a lot is, so like the 199 is based off of profit. So the higher the profit, the higher this deduction. If you have somebody who, let's just say, has $1 million of profit in their business and they pay out $900,000 in owner's wages in a W-2 in an S corporation, it's a pretty high number. The government's not going to care because you're paying more in payroll taxes. They're fine with it. It's not a C corporation, not that kind of limitation. But what you've done then is reduced this 20% by your W-2 because the company now has a profit of 100 grand instead of $1 million. So we're making sure that our clients are paying what are reasonable wages, so that we can make sure that we're maximizing this 20% and they're not kind of limiting themselves by paying large wages. I mean, there could be good reasons for it. Depends on owner involvement in the business. Sometimes your banks want you to keep a certain level. You know, there could be things that you've got going on, multiple owners that aren't related. But if there's an opportunity to kind of to maximize what you're doing in the wages and stuff, we'd make sure and take a look at that. And I'd make sure that you're talking with your accountant about it. Analyze the PEAT versus the SALT cap. It's kind of, right now, if you're going to pay that pass-through tax, the 9.3%, and let's say that it was $10,000 or $20,000 is what that amount is that you're paying, it might make sense to pay that through your personal return because now we have this $40,000 cap instead of paying it through the company. Because if you pay that 20 or 30 grand through the company, it reduces your profit on the federal side, which again reduces the Section 199A deduction, which is that free 20% deduction. So the idea is try to keep that number as high as possible, but yeah, use the other write-offs in other spots so that you're paying less. Just because you leave this high is not because you're paying more taxes, because we're taking these deductions in other areas. So, but they kept the 199A, which is good, kept the PEAT available. It's also good. Probably one of the biggest ones, at least for my clients, especially in manufacturing, is R&D. And the past few years, R&D was, it's the right word, junk, I think. So yeah, I would go with junk. What ended up happening is CCGA back in 2017 changed this rule. Nobody thought about it. They thought they were going to change it. And then come 2022, and no one in Congress had changed it, enacted. And what the rule, the it part was, is that for all of my clients who have been doing R&D for the past however many years they've been doing it, what ends up happening is you go through and you have salaries and wages that qualify, and you have outside service that qualify, and then maybe some materials and a couple other things possibly. But you take and you put all these in a bucket. Let's just say it was $1 million of expenses. You were still able to deduct those $1 million, even though they were qualified R&D expenses. And then you go through and you calculate the tax credit. And roughly speaking, it's like 10% on the Fed and 10% on the state. So just roughly speaking. So if you had $1 million of expenses, you'd get a $200,000 tax credit. You had to add back the credit depending on what you did, but it wasn't as big. You still get a lot of benefit out of that credit, right? You can have $140,000, $70,000 worth of benefit. Fantastic. One of the better incentives that we have right now, especially for manufacturing, and I'm hard pressed to think of what my manufacturers have, which ones I work with that don't have some sort of R&D. It could be different, varying sizes, but part of my background is before I became a CPA, I was a machinist for 3 years back in Kansas place, doing a lot of beryllium copper parts for, I'm guessing, atomic clocks. I'm not really sure. I was really good on Swiss lathes, really good at making these little parts that proved where they're going. But I didn't have anything to do with the designing of those parts. I'd get the blueprints, and I would just make sure the machine was programmed properly, and that I had all the tooling right to make sure that thing worked. So I didn't design the part, but I had to go figure out how to make it work. And then we had some of our own parts that we designed, some proprietary stuff. So there were certain things that I was doing that we had never done before in the business, and that it took a lot of science to figure it out, and trial and error, and it took me a long time. But it's R&D. That's basically the idea of R&D. And so I don't know which people in manufacturing really don't have some level of that. So I had a lot of clients who were doing R&D, and in 2022 they said, "Hey, look, if you had $1 million worth of expenses, you can still get the credit for 200 grand. Like, we no longer get to deduct that $1 million of expense." And so we had to add back $1 million of expense, roughly, which would add $300,000 in tax on the federal side. So they were getting a $200,000 tax credit, but it was costing them an extra $100,000. Not great. And it was not great that first year. The second year, because it's a 5-year write-off, right? So you take this $1 million and you get to write it off over the next 5 years. So the first year stunk, way upside down. Second year, less stinky, but still upside down, because the credit, you still get the credit, but now we have we have now the second year of the $1 million from the year before. Now usually R&D is fairly similar year after year, unless you're doing a whole lot of growth. But they have another, $1 million, 1/5 of that. So by the third year, it was almost break even. And then by the 5th year, we're back to where we would have been. It was costing a lot of business owners a lot of money. It was a lot of money. I mean, millions of dollars. So government came out with the BBB and says, look, we're going to go back to the way that we were, which is what should have been the whole time. It shouldn't have changed. But thankfully, they've gone through and changed so that we have some options, depending on how big your business is, what your gross receipts are. But for someone under, I think it's 33 million, you can go back and amend the prior year return. So if you went and spent, in 2022, you added this expenses back and it cost you $1 million, we can go back and amend those returns now, and you get that $1 million back with some interest. And then you can do the same for 2023. And if you already filed 2024, excuse me, if you already filed 2024, you can go through and do the same for 24, or do it on the current year's 2024. We're still waiting for some direction on how they exactly want us to do all this stuff. I've got some bigger clients that I'm going to wait for. I've got some smaller clients, like their credit is like $20,000. We're going to go through and just do it the way that I would normally amend a return and see if it gets through. If they're going to stop us, they stop us. If not. We're supposed to have 365 days from July 4th to do it. So What I don't want to do is have a bunch of my clients just wait until that 11th month and we haven't done anything to prepare on. So just make sure you get your heads ready for that, especially if you've been doing this properly in the past where you were adding this income back. But anyway, you can go back and amend those returns, or you can take and carry it forward to 2025 or 2025 and 26. And so we have a lot of opportunity to figure out what we want to do. I've got clients who paid large tax in these prior years, and to go back and amend to get back this large tax plus the interest is well worth it. Problem is, who knows how long it's going to take for them to process it. So if it's a cash flow situation, it'd probably be more cash because of the interest, but I don't know if it's going to be a year or a year and a half that they would actually process these returns and we get the money back. To carry it forward 2025, 2026, there's some opportunity there to maybe not pay. I mean, we're beginning of August right now, so maybe not pay third quarter estimates. So that could be an immediate cash flow savings, possibly fourth quarter as well. It just depends what business is looking like for the current year, maybe for 2026. But I'm very happy that this came back. I did have a lot of clients that it's kind of like the rule of thumb is, roughly speaking, 20% of businesses that do qualify know they qualify. So 20% of the people who do it are actually taking advantage, or that have qualifying activities actually take advantage of it. For those of the companies that I had that were taking advantage of it, most of them continued to do it. They just, bit the bullet and did what they were supposed to. Some of them magically didn't have R&D for a while. Anyway, just say they magically didn't have it, but it turns out magically they did. You could go back 3 years to amend on the federal side and 4 years on the state. Even if you didn't know you qualified for it, you can still go back and do this. That rule hasn't changed. But so I have people who are going to be going back and amending to actually just even initially ask for the R&D. So that's an option. And the rule really was, it's not the R&D expenses we're supposed to be added back. It's supposed to be research expenses. And research by definition is a way broader subject than R&D. R&D is much smaller. And it affected a whole lot of people, and a whole lot of people didn't even know it affected them. So it is one of those no harm, no foul deals, because we got them back and we would have changed it to what it's supposed to be. But I promise, what I was really hoping to see, which is a weird thing to hope for, but I was hoping that the IRS would have liked to argue with one of them before. So what we'll do a lot of times is for people who didn't prepare the R&D themselves, they had another company come in and do it. They'll sometimes hire us to come in because we're a licensed firm to represent them in an audit with the IRS or the state. And so I was just waiting for an audit to come in where the IRS would be arguing that someone did qualify for R&D and they should have put it on their tax return, because I would have loved that. Because all the audits I've done in my life, I've never had somebody from the government saying that someone does qualify for R&D. They're always saying they don't. I didn't see that come out. If there's a court case, it got stopped. So anyway, it's a really good deal. R&D is like one of the better incentives that we have in the manufacturing community, at least on the federal side. There's some other good ones I don't want to take away, but R&D is the once you figure it and get it done, is one of the lower hanging fruit ones. So I'm glad they brought this back and made it as attractive as it used to be. There's some other items here. There's the expanded business interest deduction, the excess business loss rules. They kind of just made these a little more favorable, I guess would be the way to look at it. I don't, if you've got a whole lot of business interest and you had a whole lot of interest expense in your business, they were kind of limiting that. I didn't have that affect a lot of clients. I mean, some in the areas it would just maybe, like less than 1% of the clients, 2% of the clients. It wasn't a lot. The excessive business loss rule, if you had really large losses, this probably wasn't the first thing that stuck out in your mind. If you had a really big loss, it was probably like, holy crap, we have a big loss. What are we going to do? But they've made those a little bit better. The ERC claims, still going on, but the IRS and the government is trying their best to just stop it. Right? They just want it done. So they have come through and said that they're no longer going to process any of the claims that were filed after January 4th, I think, of 2024. So most of those claims that came in before should still be processed. They're coming out. We've been getting some letters that state, especially here in California, that they were the third quarter of 2021, because the state had lifted most of their restrictions come that time, that they just were blanketly disallowing the third quarter. And then they said, if you don't agree with us, tell us you don't agree with us. We said we didn't agree with them because we wouldn't have filed. And so we've sent in the forms for those that were after January 4th, but it was for something that was already processed. And we're still getting money from those items. I still got clients getting money that's coming in. I've got clients that Wallace is one of the last ones that just came in and processed. Their credit was right around 2.5 million. Is I mean, it's as close as you can get to this, the limit of what it was. But it was 2.5 million, and it came in with a $750,000 of interest from the government. So they got a gigantic check from the government, which is great. I mean, that's what they should have gotten, and it shouldn't have been held on for so long. I mean, it's a nonprofit, and they should have been able to get that and do some great stuff with that stuff, with that money. Great stuff with that money. But what happened is these businesses, you were supposed to, in 2020, 2021 on your tax returns, include the credits as income. Basically, just reduce your expenses, but basically it's include them as income. And so you're supposed to do that then, pay a bunch of tax way back in 2020, 2021, and then just sit around and wait for the government to process your claim and give you the money. That goes against, there's two main ways, roughly speaking, to calculate income. There's the cash method and the accrual method. And about 80% of businesses are cash method taxpayers, which means that you report income when the money's in your bank and you report expenses when the money's out of your bank, roughly. What this was saying is like, hey, look, we want you to go ahead and file for this credit, but we want you to include that income now, even though you haven't got the cash yet. And so they were changing a bunch of these cash basis papers, telling them they need to be accrual. And so you have these people that were paying a lot of tax. Some of them will never get that money. What they have done here is it's late 2021 claims were disallowed. So like the fourth quarter one's basically just gone. Third quarter, they're trying, like I said, to say no to. I would recommend whoever help. If you haven't gotten the money yet and you're still waiting for the third quarter, try to file a petition for appeals. If you qualify for it. If not, maybe just don't. But they changed the statute of limitations to 6 years. So what was ended up happening is you have these people in 2020, 2021 that had filed the credit the proper way and include his income, still haven't gotten the money, that they were hitting the statute to be able to go back and change that and get their money back that the government still hadn't paid, good taxes back. So the government came through and said, look, we're going to have 6 year statute of limitations that we can go look, because they're still swamped. They don't understand it. They think there's some people who have still stolen money, which there are people outside the country that got money on this. It should never happen. But they've given themselves some extra time for the statute, which has also extended the statute for people who had filed and did it properly themselves and still haven't received the money. They changed the rules a little while back that said, look, just go ahead and when you get the check in, report it as income. It should have been to begin with. I had some clients that did it that way. But now we have a little bit more direction on that. The opportunity here is just with these additional losses that are coming up and not coming up, an additional way to take some of the interest and some losses, that it's possible, and maybe even some ERC stuff you have to go back and amend for it. It's just, there's maybe some ways for you to take a bigger loss in your tax return if you're looking to offset some other incomes from some other way. I've got down here for attracting investors. I mean, sometimes investors like to put money into things when they know they get to write it off, and this could be a way to help write something off. But mostly it would just be if you've got timing of your income and your expenses to try to reduce some taxes. It's pretty good. Another good one that I'm seeing, especially for right now, because we have a lot of people who are exiting businesses. They're selling their stock, retiring, whatever it might be, that this qualified opportunity zones are a way to try to help offset some of the gain from the sale of something. It could be a sale of stock. It could be the sale of business. It could be a sale of real estate. It could be a sale of all sorts of stuff. If you've got a gain on it, you're able to go through and find an opportunity zone, or you can go into what's called qualified opportunity zone fund, where it's more maybe an institutional type investor like a Charles Schwab or something. And you invest your gain into this thing or this place or this business. And as long as it's in one of the zones, which there's thousands of them around the country, that you could defer paying the gain on that for now a while, 5 years. And if you hold on to this new thing for 10 years, between 10 and 30, and sell it, you wouldn't pay any tax on the gain then. It's great. It's been around for a while, but they had this deadline of the end of 2026 that says, look, we can only defer the gain up until 2026. So it was kind of exciting to begin with, and it's been less exciting now because you just couldn't push off the gain as long. Still some good benefit to investing into these zones, if you could find a good zone, or find a good fund. But it's kind of funny. It is still more complicated than making it sound, but roughly speaking, that you can't defer the gain. Well, now we can defer the gain. Now it's instead of being a drop dead, a deadline of December 31st, 26, it's 5 years from whenever you sell. And then after 5 years, if you hold on to that new thing for 5 years, you get a little bit of a reduction in how much you have to pay on the gain, which is good. And then if you hold on to that thing that you bought for 10 years, it's really good. So we got an office in Kauai, over in Lahui. And on the South Shore of Kauai, there's a really nice golf course. And that golf course is somehow magically in the zones. So if you were so inclined, you could go build a house on this golf course, which is private. You got to live there to be able to play on it. It's a fantastic course. You could build a house on there. You could rent that house out for 200, 250 days a year, and then maybe stay in it the rest of the time and hold on to that house for 10 years and then go to sell it. And you don't probably get built in value. It's like, why? So you build a $2-3 million house over there and rent it for a couple $100,000 a year. It pays for itself. Anyway, there's some opportunities here and then you go to sell that thing 10 years down the road if you want and pay no tax on it. It's very interesting where the zones are. They rotate, they change. I don't know who's looking at it. I would think if somebody was looking at that, they would say, whoops, that probably shouldn't be in a zone, but heck, they can't do the ERCs hardly. How are they going to have somebody who's looking at zones right now? So I see a lot of opportunity. But there's not a lot of things in the tax code right now that are, black and whitish that say, look, if you were to sell something and put the gain in here, that you can defer paying the tax on the gain or not pay any tax on the gain. Like a 1031, well, they can't exchange. You sell a piece of real estate and you sell a piece of real estate and you invest in another piece of like it's non-residential real estate, or it could be rental properties, but you don't live in it, supposedly. If you do that for a 1031 of like kind, you can defer paying the gain on those. But at some point you're going to either pay the tax or you pass away and you get a step up in basis. But this is one of those things where if you bought something, you can hold on to it for a while and not pay any tax. It's pretty rare opportunity. I mean, there's some things, especially at the funds, for people who aren't necessarily inclined to want to go spend a bunch of time finding something or manage something. There could be some investment opportunity with, I was saying, those institutional investors to where you put the money in there and they're finding the stuff. And so it's qualified investment with them because it's going into the right area and they kind of manage all the properties or whatever it might be in. They have that also with like-kind exchanges called Delaware Statutory Trusts, DSTs, where you could sell a building and invest it with them, and they will, they'll do all management on something new. So, if you're looking at retiring, you don't necessarily want to manage multifamily, apartment complex or something. Then there's some opportunities there that I think you're going to keep going higher and higher now that we have this a little bit different rules for the opportunities. They got some more stuff for rural stuff as well. I mean, being from Kansas and things, there seems like there's some opportunity there that possibly buying out farmland from family or something to where the gain down the road and I got to sell that doesn't exist. But it's pretty new. It's one of the areas though that we're kind of focusing on as far, especially with people exiting businesses and selling stock and things that they're doing. All right, so on the personal side of things, especially for you closely held businesses, personal is, I mean, they're interrelated, right? An S corporation has profit. The profit flows through to the owners of the S corporation. So the company itself on the federal side doesn't pay any tax. You pay it all on your personal. Same with an LLC. C corporations pay their own tax. The C corporations are good for certain things. I do like C corporations. One of the other ones that I didn't put on there is a C corporation. They did for the sale of stock of a C corporation, a qualified small business called Section 1202 stock. They did make that a little bit more attractive for exclusion of the things to where you get to exclude gain on the sale of something. If you can find someone who's going to buy the stock of your business, you might want to look at planning for having a C corporation set up. It's not as great for the tax purposes as far as possibly having double taxation, but I do have an all right amount of clients who are on the C corporate side because they're looking at exiting from the C corporation and having the ability to sell some stock and not pay any tax on it. I see a lot of it more in the Bay Area, a lot of tech, a lot of those types of selling. And the C corps are much more easy to invest in for outside investors than like a closely held company. Anyway, but those closely held companies, S corps, those things, they're going to have an impact on your personal return. So all the stuff I talked about, it's got an impact on your personal return as well. But there's some things that were in the new bill that I just wanted to go over that people have been asking about. And, there's a lot of things like the tax brackets are just made permanent. I've got a slide in here. It is as fuzzy as a slide can be, but the tax bracket is the same. Standard deductions increased. It does a little bit all the time. So it's 31.5 grand for joint and almost 16,000 for single. What that really means is just that if you had less than 16 grand in income, taxable income, you don't really have to even file a return on the federal side. State of California is a little different. That matters for like clients that hire kids. They put, they usually don't pay them any more than that. The SALT cap is raised. I kind of talked a little bit about that earlier. That's the state and local taxes. So on all of our personal returns that we were only able to deduct $10,000 of property taxes, DMV fees that would qualify, and then state income taxes. So here in California, New York, Hawaii, those big tax states, our property taxes, if you buy, I'm just going to use round numbers, $1 million house, your property taxes are $12,000-15,000 on the thing. And then you've got state income taxes, which you're already over the 10, so what's it matter? So on the federal side, they increased that to 40,000. Good for us living here. I mean, grew up in Kansas. Some Kansans are helping to pay for us stuff here. That's great things. But what that does give us the ability to do is kind of what I was talking about with that pass-through tax, is maybe not do all of it through the pass-through, because you can still deduct. Well, you might be able to deduct it now, since if you're under the $40,000 limit. Just more planning. Just make sure that when you're talking, we start doing planning. Well, we start for the second quarter, but we're going to have third quarter planning. We'll do some before the end of the year. And just make sure when you're doing your planning with your accountants, that you're talking about these things. It's like, everybody's going to be looking at it, but it's like, should we do more pass-through tax? You probably already paid something by June 15th, because there's a deadline that you have to pay a certain amount by June 15th to do that pass-through thing where you pay your state income taxes through the business. But maybe it makes sense not to do that this year. So, because obviously they didn't tell us the rule until July, and had to pay it by June 15th. So it's, but anyway, so it's a good one. It's been in the news a bunch. It does phase out $500,000. So if your income's high, it won't really matter. So right back to the pass-through deal. Here's that fuzzy thing. I am not going to spend any time. Charitable deductions. So if you don't itemize, you can write off up to $2,000 worth of cash donations. It's fun. Most of my clients itemize. So if they do, the itemized people are going to face, it's a 0.5% AGI floor. It's a haircut, basically. So it's the same thing as medical expenses. If you go to your accountant, you say, look, I had $10,000 in medical expenses this year. Kids all got braces or something happened, and I want to know if I can deduct it. And they said, well, how much money did you make? Like, well, I made 100 grand. It's like, well, the limitation is 7.5%. So $7,500. So you take that 10 grand less 7,500, you could write off $2,500. That's the 7.5% floor we have for medical expenses. We now have a floor for charitable donations. It's a small percentage, but it exists. C corporations is 1%. I don't have a lot of people who do big donations through C corporations. I just maybe some inventory and some other stuff like Sierra College or things like that, which is amazing. But most of that doesn't go through C corps. The opportunity there is to group contributions, just like you would if you were going to do medical expense and you were over the thing. Maybe you pay for some stuff that's going to happen the next year. You pay for it quickly. I'm seeing a lot of clients now with donations that are doing it through donor advised funds. So they can do talk about grouping it. They can do a large chunk, usually appreciated stock, right? You don't want to sell stock, pay the tax on it, and then give that cash, the remaining cash, to a charity. It's not as good a benefit if you just donate stock, because you get, whatever it's worth now when you donate it is what it looks like you gave away. So you get a better donation for it. So I have a lot of people who are doing those nowadays. So I don't know how big of a deal this will be, but people are asking me about it. So I put it in. 1099 stuff. No, threshold's $2 grand. That keeps changing. Yeah. Someday, it's, eventually we're going to all be cashless, and then they're just going to know where all the money goes, I guess. This one does kind of matter a little bit for those of us that are maybe in the manufacturing of solar and related equipment. Clean energy tax breaks are ending 25 and 26. So for electric vehicles, those are gone come into September, I believe. So $7,500 you get for going out and buying a new Rivian or a new vehicle like that. There's some limits that we had if you're going to do it personally. It kind of didn't make it as attractive. Vehicle had to be, certain restrictions on where it was put together. But they had the commercial clean vehicle credit, which did through the business, had none of those restrictions. Those are all going away. So those are gone by September. If you're going to go get something, you want that $7,500 credit. If you were going to qualify for it, you need to go do it quick. The residential solar is going away by the end of the year and of 2025. And it's got to be through inspections. Like it's got to be working by the end of the year. So if I've got a client down south, she's going to put $2 million of stuff on their house. It's a big house. And she thought she had until, was it July or June of 2026? Like, you do not. It's not a business. It's your residence. Maybe you could try to make some argument for some. There's not really an argument to be made anymore. But even if she can find a contractor to put all that stuff on the building right now, whether or not you can get somebody from the county to come out and sign off on it, it's possible you need to close the permit. I don't know for sure, but it seems like it's kind of what they wrote in there. Anyway, the solar's kind of going away. I see there being a big push, and I don't know that I don't know if they can get. I think somebody can get stuff on your building in that amount of time, and if they have somebody who's a friend that can get all the stuff tested and everything, which they might have. But just know there's a deadline coming up. Trump accounts for young kids. So your kids, again, if you have new kids just born coming up 26, the government will put $1,000 seed money into one of these accounts called the Trump account. And then your grandparents or somebody could put $5,000 a year into them. It's great. I love the idea of putting money away for kids. It'll grow tax-free, which is great. When they go take the money out, that money will be taxed, the income will be taxed. So it doesn't exactly say, but we're guessing it's kind of like a non-deductible IRA, where you'll have basis for whatever you put in. So if you put 10 grand in and it's worth 15 grand, that's that $5,000 difference that you'd have to pay tax on if they took it out. Trump accounts are good because the kids don't have to have earned income to be able to put money in there. A Roth IRA would be better, I think. But maybe some educational accounts might also be better because they can put money in. You don't get a deduction for it. You don't get a deduction personally for putting the money in, but you take the money out of a Roth and none of it's taxable. And it's not like you follow rules. And then for educational stuff, they have really opened up what you can use for educational things. It can be for traded schools. It can be for K through 12. There's a lot of things you can use that for where it won't be taxable. So there might be some other accounts that are good. Hey, put $1,000 in there, and if it's going to get other people saving money, I've read some articles about how this is supposed to be first step in privatization of Social Security. I don't know about that, but anyway, it exists. And if you don't have earned income for kids, or if you aren't a business owner and you don't necessarily have the ability to have your kid get paid $6,000 so they can put it into a Roth IRA, then this might give you another option. Gambling losses capped at 90%. Maybe it'll affect a client of mine somewhere. I'm not really sure when. Itemized deduction phase out. Yeah, we have that. You make a lot of money, the itemized deductions start going away, but it's not a gigantic amount. And itemized deductions that we have really, we're limited on mortgage interest now to $750,000 of principal, basically. Donations would be the thing. You don't really get itemized deductions to speak of. They're very small. Like donations for educators or things like that. So I just don't know that it's going to be a big deal, but it exists. And the other one that people are talking a lot about now is personal interest on new car loans. So you can write off up to $10,000 of interest on a new car loan as long as it's been completely assembled here in the United States. There's some restrictions that go on. It's got to be new. Can't refinance a car. Got to have your income's got to be under a certain threshold. I think it's a couple $100,000. But if you own a business, your chances are that you're writing it off through the business already anyway. So, I think this would be more for those, possibly a spouse if your income's low enough. Maybe your employees. I think there will be some people that get to take advantage of it for sure. Just want to make sure your accountant's asking for it. I think that was it. If anybody's got any questions, I know when I talk fast, feel free to please let me know. If Scott right here, you can scan in, it's got my contact information. I am happy to answer any questions at any time for anybody from CMTA. It's a good group, and I want to make sure that we're helping where we can for people to, I don't care if I do your stuff or not, I'll be happy to talk. But I want to make sure we're helping people save money, especially with this. There's a lot going on, and there's some things that are very specific to manufacturing. There's some things that are very specific to different types of manufacturing, different people, trying to figure out income and whatnot. So So for planning, I think you're gonna see a lot of it this year, and I'm happy to talk to anybody about it. If you got questions on the R&D thing, happy to talk.